Welcome to the Explainer. You know, if you've spent any time at all staring at financial charts, you're probably pretty familiar with candlestick patterns. And well, traders have been arguing for literally decades, in chat rooms, on trading floors, you name it, about which of these patterns paints a truer picture of a market top. Well, today, we're going to settle it once and for all. We are setting up a clash of the titans. We're taking two of the absolute most popular, most powerful reversal patterns out there and putting them head to head, the shooting star and the hanging man. Over the course of this explainer, we're going to tear these patterns apart, look under the hood at the intraday psychology, and figure out which one is the undisputed heavyweight champion of reversals.
So picture this scenario. You're trading and you spot a potential reversal. Gun to your head, if you had to pick just one of these patterns to align yourself with for the entire next year of your trading, which one would it be? I mean, which one do you actually trust more with your hard-earned capital? It's a highly subjective question for sure, and traders look at this very differently. But before I reveal the ultimate winner based on our analysis, I want you to lock in your guess right now.
Okay, let's dive into this. To properly crown a champion, we need a game plan. First up, we'll look at the reversal setup. Then we'll meet the hanging man, followed by meet the shooting star. After that, we'll get into the intraday battle. And finally, we will crown the winning pattern.
Section 1. The reversal setup. Spotting the turn. Because, before we even look at the shape of a candlestick, we have to look at the environment it lives in. Context is absolutely everything here.
For either of these patterns to mean anything at all, the market must have been pushing up. We need a clearly established uptrend just chugging along. Then, suddenly, one of these patterns appears right at the highs. When that happens under those specific conditions, it can be a massive signal that a powerful reversal is imminent. And what makes this setup so fantastic for us as traders is that the risk is completely quantifiable. Think about it. Trying to guess the bottom of a market crash? It's usually compared to catching a falling knife. It is notoriously dangerous because you literally don't know where the floor is. But catching a reversal at the highs with one of these patterns, totally different ballgame. Because the pattern forms at a peak, you know exactly where to place your stop loss, typically just right above those highs. If the price breaks above that peak, well, you know immediately that you were wrong, and you can just exit with a small, manageable loss. It's a clean, totally quantifiable risk profile, which is basically the holy grail of trading. It's just a phenomenal setup to have in your arsenal.
All right, let's move right along to Section 2 and meet our first contender in this showdown. Meet the hanging man, the bearish dip.
The hanging man gets its name from its very distinct shape. Just imagine a stick figure. You've got the small red body sitting right at the top of the candle's range, and below it, there's a very long wick, or like a rope, just hanging down. And as a quick technical detail here, for this to be a true hanging man, that wick typically needs to be at least twice the length of the actual body. It's a highly recognizable shape that shows up after a market has been climbing. But to really, truly grasp what's happening, we can't just look at the daily close. We have to drill down into it.
Let's see how this actually builds on an intraday level. Imagine what goes down throughout the trading day to create this exact shape. Step 1. The morning bell rings, price opens right at the highs, continuing that bullish momentum we've been seeing over the past few days. Everything is looking great for the buyers, right? But then, step 2 hits around midday, and sellers suddenly step in. After a week of basically not seeing many sellers at all, they arrive in force and they drive the price significantly lower intraday. Now here's where it gets super fascinating. Step 3. As we head into the afternoon session, the bulls, the buyers, well, they're still there. They look at this sudden midday dip, they perceive it as a great value, and they buy it right up. They aggressively push the price all the way back up to close very near where it opened. So yeah, the candle is red, sure. But the buyers stepped in and recovered a huge chunk of that drop before the final bell even rang. Now, let's jump to Section 3 and meet our second contender. Meet the shooting star, the failed push. If the hanging man is a body with a rope below it, the shooting star is the exact opposite. It gets its name because, well, it looks like a star shooting upwards with a trail dragging behind it. You get a small red body at the very bottom of the candle's range with a long wick shooting way up into the sky. Visually, these two are almost perfect inversions of one another. Think of this long upward wick acting almost like a pin popping a massive balloon. The momentum goes up, hits that pin, and just completely bursts. The story this shape tells is radically different from the hanging man. Let's look at the intraday story here for the shooting star. The day begins in step 1. Morning bell rings, and the price opens and pushes higher. The uptrend is just continuing, chugging upwards exactly as it has been. It looks like it's going to be another incredibly strong day for the bulls. But then, step 2 hits.
Maybe they slam into a massive historical resistance level, or maybe some sudden piece of bearish news hits the wires. For whatever reason, supply and demand shift instantly. Sentiment completely changes on a dime. Sellers aggressively hit the asset, and in step 3, they don't just push it down a little bit to create a dip. They drive the price all the way back down, right through the open, and force it to close at the absolute lows of the day. It is a wildly dramatic intraday change in sentiment.
And that brings us to section 4, the intraday battle, bulls versus bears. This is where the real showdown happens.
Now, what's really interesting about this slide is exactly who ends up in control at the end of the day. With the hanging man, the sellers showed up in the morning, but the buyers stepped right up in the afternoon. The buyers clearly haven't run out of steam yet. They still see value on the dip. They fought back. But with the shooting star, the bulls showed up in the morning and the sellers just completely crushed them in the afternoon. The bulls have entirely run out of puff.
All right, we've reached section 5, the winning pattern, crowning the champion. We've seen the setups, we've met the patterns, we've analyzed the intraday psychology. It is time to crown the champion.
So the crucial point comes down to this. If you have a gun to your head and you have to pick the absolute best pattern to align with for the next year, the winner is the shooting star. It is, without a doubt, the superior reversal signal.
And here is exactly why it wins. The hanging man, despite having this big bearish reputation, actually just looks like the pattern of a totally normal bull market. Think about it for a second. In a strong bull market, you often see a dip in the morning and a rally in the afternoon. Traders just love to buy the dip, right? The hanging man is basically just an exaggerated version of a normal buy the dip day. But the shooting star, oh, that is a total disruption. The normal upward movement is suddenly and violently rejected. Sellers don't just slow the asset down, they drive it straight back through the open to close at the lows. Think about the massive psychological damage done to the bulls here. All of those buyers who enthusiastically bought that morning breakout, they are now trapped completely underwater by the afternoon. They are sitting on losses before the day is even over. Because of this complete exhaustion of bullish sentiment and this whole cohort of trapped buyers who are now just eager to break even, the likelihood of a downward continuation, which basically means panic selling on days 2, 3, and 4, is much, much higher. The sellers have completely planted their flag and demoralized the competition.
Now, actually, let me add a quick caveat here, because this is where strong risk management really comes into play. Does this mean the hanging man is totally useless? Absolutely not. You should never disregard it completely. It is still a super interesting mark for the bears because it often represents the very first time reasonable selling pressure has appeared in the market for a week or more. It's an early warning sign. As a responsible trader, you should always be checking the context, like how deep that wick actually is, or if it took out prior lows. Because nothing in trading is ever completely clear-cut, so keeping your stops tight and respecting the warning signals of a hanging man can genuinely save you from a major drawdown.
Which really brings us to the core philosophy of our explainer today. It is so incredibly easy to just look at a chart, spot a shape, and say, oh, that looks pretty. Someone online says sell this, so it goes lower and we're all geniuses. But we have to think a little deeper. We absolutely must. Every single candlestick represents a story. It's a brutal intraday war between buyers and sellers. When you understand what actually happened during the day to create that specific shape, you understand where the market might go next, what happens if the trade goes completely wrong, and exactly where you need to frame your stops to protect your capital.
So we've officially crowned the shooting star as the absolute king of this reversal showdown, thanks to the undeniable sheer force of the sellers taking control right into the close. But hey, the ultimate test happens on your own screen. The next time the market is chugging up to fresh highs and you see one of these patterns form, which one are you going to trust with your next trade? Will you bet on the hanging man's early warning or the shooting star's total exhaustion? Take these insights, look a little deeper at your own charts, and trade smart. Thanks for joining me on The Explainer.